All right, let's talk about a really powerful retirement strategy, one that's especially for high-income earners. It's called the Backdoor Roth IRA. It's a fantastic way to get that sweet tax-free growth, even if you technically earn too much to contribute. But, and this is a big but, there's a hidden tax trap that can cost you thousands if you don't know how to avoid it.
Okay, before we dive in, the really important legal stuff. This is all for educational purposes. I am not your financial advisor, and this isn't tax advice. Everyone's situation is different, so please talk to a qualified professional before you make any decisions.
So, you're in this spot, right? You're doing well, you're earning a good income, and you keep hearing about the amazing benefits of a Roth IRA, all that tax-free growth and tax-free withdrawals when you retire. The problem? The IRS says you make too much money to put funds in directly. So are you just locked out?
Well, not exactly. Enter the Backdoor Roth IRA. Now, it's important to know this isn't some special account you can open. It's a strategy, a two-step process. You put money you've already paid taxes on into a traditional IRA, and then you immediately convert it over to a Roth IRA. Sounds pretty straightforward, right? Well, it's not always that simple.
To really see how this works, and more importantly, where it can all go wrong, let's make this real. We're going to follow the story of a smart investor who's trying to use this very strategy. So our investor's been saving for a while. They've got an old rollover IRA that's sitting there with $150,000 in it. Now this is key. It's all pre-tax money that they rolled over from an old 401k. This one little detail is about to become the most important part of our story.
Okay, so our investor decides, this is the year I'm doing a backdoor Roth. They open a new traditional IRA, put in $7,000 of their after-tax cash, and they're all set to convert it. But this is it. This is where the trap springs. That pre-existing IRA is about to create a huge tax headache.
And the name of this trap is the Pro-Rata Rule. Basically, it means in proportion. And here's the kicker. The IRS does not care that you have separate IRA accounts. For tax purposes, they look at all your traditional IRAs, your SEP IRAs, your simple IRAs, and they see them as one giant single pool of money. So here's what the IRS sees. They take that $150,000 from the old account, they add the new $7,000 contribution, and to them, it's just one big pot of money worth $157,000. You can't just point to the new money and say, hey, I only want to convert that part. It doesn't work that way.
So when our investor tries to convert that $7,000, the IRS essentially says, hold on a minute, only about 4.5% of your entire IRA pool is after-tax money. The other 95.5% is all pre-tax. This means any money you pull out for a conversion has to have that exact same mix.
And that leads to this. A shocking 95.5% of what was supposed to be a tax-free conversion just became taxable income. You thought you were making a smart tax move, but you actually just handed yourself a surprise tax bill. This is the exact opposite of what you wanted. Okay, take a deep breath. At this point, you're probably asking the most important question. How on earth do you get around this? How do you actually get the clean, tax-free conversion you were promised?
Well, you have two main paths to deal with that big pre-tax IRA. Option one, you could just convert the entire $150,000 to a Roth. But that would mean paying income taxes on the whole thing this year. Ouch. That could be a massive tax hit. Option two, and this is the secret sauce, you roll that entire pre-tax balance into your current employer's 401k.
The goal here is actually really simple. To pull off what we call the clean backdoor strategy, you need to get your total traditional IRA balance down to a big fat zero before you do the Roth conversion.
So here's the playbook, step by step. First, you call up your current 401k provider and just ask, hey, do you guys accept roll-ins from an IRA? If they say yes, you roll that entire pre-tax IRA balance into it. Now your traditional IRA balance is zero. And now you can make your new after-tax contribution and convert it to a Roth, completely avoiding that pesky Pro-Rata Rule. And this right here, this is the magic key. This is the loophole that makes the whole thing work. The tax code specifically says that 401ks are not part of the pro-rata calculation, so by moving the money there, it's like putting it in a safe zone where the IRA aggregation rule can't touch it.
Now listen up because the timing on this is absolutely critical. The IRS only cares what your total traditional IRA balance is on one specific day, December 31st of the year you do the conversion. That means you have to get that rollover into your 401k completed by the end of the year. Don't wait until the last minute.
And you know what? Your employer can be your best friend in this process. Most big company 401k plans are set up to accept these funds. They call it a roll-in or sometimes a reverse rollover. Your first step is super simple. Just get in touch with your HR department or the plan administrator and ask if it's an option for you.
Okay, so you did it. You moved the money, you did the conversion, you avoided the tax trap. You're basically at the finish line. But there is one final important piece of paperwork you have to take care of. You've got to tell the IRS what you did and that you did it correctly.
And you do that with IRS Form 8606. Don't let the form number scare you. You just file it with your regular tax return. Think of it as your official receipt to the IRS. It creates a paper trail that proves, hey, this money I converted has already been taxed. Don't you try to tax it again.
And this right here is the bottom line. It shows you the massive difference this one move makes. With no pre-tax IRA, your conversion is pretty much tax-free. If you have that big IRA and you just ignore it, boom, almost the entire $7,000 becomes taxable. But by taking that extra step to roll the IRA into your 401k first, you bring that taxable amount right back down to nearly zero. We're talking about a difference of thousands of dollars.
The Backdoor Roth IRA is a phenomenal tool, but you have to know the rules of the game to win. So the final question is for you. Now that you know about the trap, and more importantly, you know about the solution, is your retirement plan truly built to be as tax efficient as possible?